What's going on, you guys? Welcome to the video. My name is Brandon. In today's video, we're going to be talking about when it's a good time to sell your stocks. And this is a question that I actually get on the channel all the time. It's one of the more common questions that I've been getting, and it's a very good question because, especially on YouTube, everybody talks about stocks to buy, 3 stocks I'm watching. You'll hear, of course, of the buy and hold strategy, but very seldomly do people talk about when is it a good time to sell your stocks. But of course, knowing when to sell is a crucial component of, the portfolio management process. So in today's video, we're going to be going over 4 scenarios where it would be a good time to consider selling your stocks. If you guys enjoyed today's video, be sure to give it a thumbs up. If you're not already subscribed to the channel, also consider subscribing. I post a video like this every Monday. And if you want to check out our private membership group, you can take a look at my personal investment portfolio. You'll get instant email updates when I personally go out and place trades. That'll be that first link down in the description below. But the first scenario where you should consider selling your stocks is after we've experienced a very strong run-up. And if there's one thing that we know about equities, it's that over time, at least if we're talking here about good quality stocks or good quality companies, over time they grow and they appreciate. But it is by no means like a smooth linear line like this, right? In fact, it's pretty much the exact opposite. Stocks are constantly swinging between being overbought, and maybe we'll use the term overvalued, and then there'll be periods of time where they're kind of oversold or undervalued. They're constantly swinging up and down. They all kind of go through their cycles. And we take a look here, for example, at Aurora Cannabis. This is everyone's favorite stock. And it's always easy to say in hindsight, but ideally, looking back, it would have been nice to have bought down here and sold up here when the stock was trading at the higher range of its trading band. Maybe again, you could have bought back down here and then sold again after the stock had experienced a nice run. Another example we can look at, even a less volatile stock like Procter & Gamble. Even a stock like this goes through its cycles. All stocks go through their cycles, and at certain times, they may be trading above or below what the company's actually worth. And you can think of it kind of like a ever-swinging pendulum, like a pendulum that swings back and forth like this. And a stock is constantly swinging between investors buying the stock and momentum kind of driving up the price of the stock, sometimes to the point where it becomes overvalued. Then we have investors take profits, they start to sell out of their positions, which then drives the stock back down. So if you own a stock that has just experienced a very strong run up and you believe that it's starting to trade kind of towards the upper range of its band, it may be getting overvalued. Maybe you can be looking at something like the RSI, which basically gives us an indicator of whether the stock is overbought or oversold. It is never a bad idea to trim back and lock in some profits. Notice that I say there, trim back. I'm not saying like wipe out your entire position or go sell the entire stock. If this is a company that you're holding in your portfolio because you believe in the company, because it's a good company and it fits your overall asset mix, just because it's experienced a nice run, that doesn't mean you need to blow it out of your portfolio, but trimming back and locking in some of those profits before the stock cools off and ends up giving that back to the market is usually a good thing to do. Take, for example, maybe you own 100 shares of a specific stock. And if that stock's performed very well as of recently, you made some good gains on that position, maybe you'd consider selling like 25 shares, like a quarter of that position, to lock in those profits, and then you can take those profits and deploy them somewhere else into your portfolio. Another example or another scenario is maybe your original investment cost, like your cost basis was, let's say, $1,000 or $10,000. If you've had enough gains in that position to recoup that original investment, that's another option as well. So you're essentially taking that off the table and playing with house money, or you're playing with your gains. And that way, if the stock continues to go up, which it very well could, you still have the exposure to the stock, but you have made the prudent move from an investor's standpoint, kind of taking some off the table just so that you're not overexposed and you've locked in some profits. So that would be the first scenario where I think it would be a good time to consider selling your stocks after a strong run up, just to secure those profits. Moving on to the second scenario is when you need to withdraw money from your portfolio. And this is one that I try to avoid pretty much at all costs. Personally, the way I like to go about it is I kind of treat my investment portfolio or my investment account as my long-term savings. This is my long-term investments. And the money that I put aside in there, I don't really ever want to touch. And I always do have money available in my bank account, like maybe like a little slush fund, or maybe you'll have a high interest savings account or an emergency fund in the case that you do need to access some money. Because from time to time, like things come up and yeah, maybe you do need money for, your car breaks down. Maybe some family emergency comes up, or maybe you're just at the age where you need to start peeling money out of your portfolio. Whatever the case may be, if you need to take money out of your portfolio, well, you'll have to sell some of your stocks. And I wish there was kind of like a set system or like a systematic process as to which stocks you want to sell. But in my opinion, you really have to take it case by case because each and every one of our portfolios are different. We all have our different capital gains that we have to factor in, especially in a non-registered account. We all have our own specific asset mixes. So there isn't really a systematic process that's kind of like standardized. But personally, what I like to do if I need to withdraw money from my portfolio, and I have before, I try to avoid it as much as possible, but there have been times where I have dipped into my investment account for a vacation or whatever it was. Not proud to say that, but let's say, for example, you need a couple grand. I personally like to pick a single stock, pick your least favorite stock, one that you can live without, and I would peel the money out from that single position. And hopefully you made some gains on that, so you're not selling a stock that's down for you. But I just like to wipe out the entire stock, just liquidate the entire position. Because if you take like a significant chunk out of a stock, let's say you withdraw 70% of your shares, or you sell 70% of your shares, well, that's now going to be a very small holding in your overall portfolio. And the weighting just might not make sense if all of your stocks are equally weighted and then you have a very small position. I like to just liquidate the entire position. I also think that it's a better idea than trimming from each of your holdings. Let's say, for example, you own 10 stocks or 20 stocks. Realistically, you don't want to go and you wish you could, but you don't want to go and sell a little bit from each stock because you'd be paying way too much in commissions. So if you do need to withdraw money from your portfolio, like I said, pick maybe your least favorite stock. Hopefully it has a gain on it. And I would just say deplete that entire position to get the funds required. Moving on to the third scenario where you would consider selling a stock, and this is during your rebalancing process. And most of you guys, if you're investing properly, should have some form of asset allocation set or at least some guidelines or targets as to how your portfolio is going to be invested. Let's say, for example, you're a 40-year-old investor. Maybe you're running with like a 60-40 split. So 60% of your portfolio is invested in equities, 40% of it is invested in bonds or fixed income. Well, if a year goes by and the markets are performing really well, right? We're in the heart of a bull market. A year goes by and your equity component may now be 70% or 75% because the stocks have been growing and performing well. Well, as tempting as it is to let that ride, you should probably be rebalancing that back to your stated targets. Very similar to the first scenario that we looked at, talking about trimming back on your profits. During the rebalancing process, it's the same idea. In this case scenario, you'd be peeling back from your equity component and reinvesting that money back into the bond component to get you back on your target weighting. And on a side note, I know that it sucks to peel back from your winners, and it sucks even more to take that money and reinvest it back into the losers of your portfolio. But as we kind of touched on in that first scenario, stocks, assets, they're constantly going through their cycles. And if bonds have been performing poorly, for example, and they're the smaller component of your portfolio, at least over the last year, maybe this year or next year, it could be a completely different story. So it is very wise to take the profits, reinvest it back into the crappier areas of your portfolio. Ultimately, what you're doing there is your dollar cost averaging on your poorly performing assets. So that would be the third scenario where you'd consider selling your stocks during the rebalancing process. And even for somebody that's like 100% weighted in equities, so an all stock portfolio, you could follow a very similar process too. Maybe you have targets set for 20% invested in the tech sector, 15% of your portfolio in financials. And if it's all out of whack, like I said, you just follow a similar rebalancing process, selling and then rebuying to get your portfolio back on track. The fourth and final scenario where you would consider selling your stock is when you're ready to cut ties with a position. And as much as we'd love to sit up here and just pick winner stock after winner stock after winner stock, reality is, as part of being an investor, if you pick 10 stocks, one or two of them, maybe more, may not pan out as planned. And that's what happens, right? That's part of being an investor. And if you have a stock that has dropped a significant amount, you may decide that it's time to cut your ties with that company and just take a loss. And one of the main reasons that you'd encounter a scenario like this is, let's say you pick a stock, you do your due diligence, you do your research on the company, it looks like a great company for you, and it very well may be, but 6 months later or a year later, the company changes their CEO, or they announce something material, something big has changed with the company, or they make a poor decision in terms of the way they're managing the company. Your original investment thesis may no longer be valid. And if because of that news, the stock has resulted in a pretty significant drop, well, you have to reassess your investment plan and decide whether you want to continue holding this company. And at the end of the day, what it really comes down to, if you have a stock that's down a pretty big chunk, let's say, 40%, 50% or more, the question that you have to ask yourself is, can that money be used elsewhere? Can that money be used better somewhere else? And in many cases it can. It's actually worth it to take the loss and redeploy that money somewhere else. Without a doubt, it sucks to take a loss in your portfolio. I've been there. Nobody likes taking a loss, but as part of being a good investor, you have to be able to sometimes acknowledge when you've made a mistake, and you have to be able to cut those ties, put it in the rearview mirror, so that it doesn't just drag down the performance of your portfolio. You have to be able to cut ties, deploy that money somewhere else, and just look forward. And of course, guys, I'm not talking here about if there's a broad market crash and the stocks are down, 20, 30, 40%. I'm talking here about a specific stock because the company made a poor decision. So guys, those are my 4 scenarios where I think that it would be a good time to consider selling a stock. At the end of the day, especially for a younger person like myself, you can get away with just buying. You can just buy and accumulate and accumulate. And if you're buying good companies, just buy the dips, because we have so much time to let these investments recover and grow. But the older you get, the more important it becomes to learn and develop the skill of when to sell your stocks. If you guys enjoyed the video, be sure to give it a thumbs up. And if I missed anything, let me know down in the comment section below. If you're not already subscribed to the channel, guys, I post a video every Monday. So subscribe and make sure you hit the bell for notifications. Like I said, if you want to check out our membership group, guys, it's that first link down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.